Closing entries are prepared at the end of the accounting period. We've already recorded all of our regular transactions, and we've recorded the adjusting entries. We prepared our financial statements also. Now we're ready to get our books so that they will be ready to start the next accounting period. Why do we prepare closing entries? 2 reasons. First off, there's certain accounts in our books that we are going to need to zero out so that they start the next accounting period with a zero balance. For example, if I had $100,000 rent expense on my books in the year 2020, I would not want to start the year 2021 saying I have that same amount of rent expense already. Instead, we want the next year to start with a zero balance. So there's certain accounts that we're going to have to zero out so they will start the next accounting period with a clean slate, a zero balance, and next year's financial statements will reflect that year's transactions only. The second reason we need to make closing entries is to update our retained earnings account. On the retained earnings statement, we have calculated what our ending retained earnings is. We said it's our beginning retained earnings plus net income minus net loss and minus any dividends. But we've not fixed our books to reflect that same balance. So once we finish making our closing entries, we will then have updated our retained earnings account so that it shows the correct balance in this account. To understand closing entries, you need to know that we have 2 major ways that we could categorize our accounts. The accounts that we close out and the accounts that we don't close out. The accounts that we close out are called temporary or nominal accounts, and those are my revenues, my expenses, and dividends. By close out, I mean that we will set their balance equal to 0 at the end of the accounting period. The accounts that we do not close out are called my real or permanent accounts, and those are my assets, liabilities, and capital, my stock account and retained earnings. Whatever balance those accounts have at the end of the year is the balance they will start the next year with. So if I have $100,000 cash at the end of this year, I will start next year with $100,000 cash also. Similarly, if I have $100,000 in accounts payable at the end of this year, I'm going to start next year with still owing that same $100,000. We're going to make just 2 closing entries. My first closing entry closes out my revenues and expenses, and I will close them out to the retained earnings account. And my second entry closes out dividends, also closing it out to retained earnings. To close revenues and expenses, well, understand that by to close we mean to get their balance down to 0. Revenues have a credit balance already. If I want to get them down to 0, I'm going to have to debit them. Now I have put here just X revenues because we would debit each revenue account individually. Fees earned, rent income, interest revenue, and so forth. We debit each one individually for the balance it currently has so we get it down to 0. Expenses have a debit balance to begin with, so if we want to get them down to 0, we've got to credit those accounts. Again, I put X expense. We would list each expense individually because we have to close each one out individually. So whatever balance it has right now in our books is a debit. We're going to close it out with a credit to those accounts then. Once you put in these 2 parts of the journal entry, my next step is to simply make it balance by forcing whatever we need to retained earnings. What you'll find is that if we have net income, which means that my revenue exceeds my expenses, in order to make this entry balance, I would have to credit retained earnings for whatever it takes to make it balance. If I have a net loss, you're going to see I have more expenses than I do revenues. To make that entry balance, then, we're going to debit retained earnings. After you make that entry, think about, does it make sense? For example, if I have a net income, I should find myself crediting retained earnings because crediting capital makes it go up, and earning a net income makes the net worth of my business go up. If I have a net loss, you should find yourself debiting retained earnings because debiting retained earnings, which is a capital or equity account, makes it go down, and incurring a net loss makes the net worth of my business also go down. So to make this entry balance, whatever it takes, be it a debit or a credit, it's going to go to retained earnings. My second entry is simpler. It's simply to close dividends. Dividends have a debit balance, so to close out dividends, I'm going to have to credit them to get them down to 0. And the other part of that entry then is a debit to retained earnings. Debiting retained earnings makes this capital account go down, Well, paying dividends made the net worth of my business also go down. One account we don't close out is retained earnings. We do use retained earnings in both of my closing entries. However, we will not zero out retained earnings. The only time we will zero out retained earnings is if we are ceasing operations, we are going out of business, and that is not going to happen this semester. So we will use retained earnings in our journal entries. However, we will not close out the retained earnings account. Let's do an example of closing entries. I've given you a list of accounts here. Let's look and see which ones we will close out. Well, we will not close out cash because it's an asset. We will not close out retained earnings. We're not going out of business. We will close out my dividends in my second closing entry. We will close out fees earned and interest earned. Those are my revenues. We will close out rent expense and depreciation expense. Those are my expenses. We will not close out notes payable. We will not close out any of the receivables, nor equipment. We will not close out accumulated depreciation because it's a contra asset and it goes right along with the assets, nor will we close out my common stock. So these are the accounts I'm going to close out. The remaining ones I will not. My first closing entry is to close my revenues and expenses. We have two revenues, so to close them out, we're going to have to debit each one individually. That gets their balance down to zero. To close out my expenses, well, we have two of those. They have a debit balance, so we have to close them out with a credit. Credit each one of those individually to get their balance down to zero. If I have debits right here that total 54 and credits that total 29, in order to make this entry balance, I'm going to need a credit for 25, and that will go to retained earnings. That is my net income. Why? Because my revenues of 54 exceeded my expenses of 29. Therefore, I have a net income of 25. That makes my retained earnings go up. Earning a net income makes the net worth of my business go up. Let me show you another way. If you're more comfortable, you can do that, and that is to make a separate entry to close out your revenues versus your expenses. We could debit my two revenues to get them down to zero, and we could come right then and make one credit to retained earnings for the total if you would like. Then we close out my expenses. My two expenses have a debit balance. I close them out with a credit, come back and fill in my one debit. It goes to retained earnings for 29. And if you think about it, the net effect of that transaction is exactly the same as we did previously. We made a credit to retained earnings for 54, a debit to it for 29. That's making the retained earnings account therefore go up by 25, which is the same way as we did it in the original one entry. So you can do it whichever way you prefer. You can close out revenues and expenses all in one entry, or you can make one entry to close out revenues, one entry to close out expenses. The net effect is going to be the same either way you choose to do it. Finally, we're going to close out dividends. Dividends have a debit balance, so we're going to close them out with a credit to dividends. Write that on the second line indented. And then my debit goes to retained earnings. Debiting retained earnings makes it go down. Paying dividends reduces the net worth of my business then. Now that we've finished this, let's look and see what's happened to the retained earnings account in my general ledger. Well, first off, if we were to prepare a retained earnings statement, it would look something like this. My beginning retained earnings was 33. That was given to us. That was a balance given to you in that account. I had a net income of 25, which makes my retained earnings go up. I paid dividends of 7, which makes it go down. On this simple example, I'm not going to calculate the increase or decrease. Actually, it would be an increase in retained earnings of 18 if I had gone to all that detail. But 33 plus 25 minus 7 says that my retained earnings at the end of the year then is 51. Well, now let's look at my retained earnings account in the general ledger. We already had a beginning balance of 33. In my first closing entry, I credited that account for 25. And in my second closing entry, I debited that account for 7. 33 plus 25 minus 7 gives me a balance of 51 in the retained earnings account on my books right now. And if you looked at your statement of retained earnings or statement of stockholders' equity, you would see now that what we just reported, just on the previous screen, we calculated as my ending retained earnings was 51. What are we showing for retained earnings in the general ledger? 51, the same amount. What will my beginning retained earnings be to start the next period? 51. So we've now got my retained earnings account in the general ledger up to date. It equals the same balance as what we show in retained earnings on the statement of retained earnings or stockholders' equity.